To demonstrate the role and importance of venture capital in a well-diversified portfolio, I have chosen to build this presentation around a real-life case study of a locally based venture capital success story. This presentation focuses on an Adelaide-based IT company that was financed completely by private equity in its early stages of development. The outcomes of the case study both support and challenge many established theoretical claims made about the characteristics of venture capital and enforces the idea that this sector should play an important role in any investor's portfolio. I will talk briefly about the important role venture capital plays in an efficient economy, and I'll outline some generally accepted characteristics of venture capital investment. I will then proceed to explain how venture capital investments generally move in relation to other sectors of the market and how this will affect the overall portfolio of an investor. I'll then move on to the case study that is based on an existing private IT company that cannot for confidentiality reasons be named. The presentation will also feature an interview with the CFO of the company regarding the performance of his privately funded entity. To conclude, I'll reflect upon the compelling evidence to reiterate why venture capital should play a role in a well-diversified portfolio. Venture capital and seed capital investments tend to focus on high-risk, high-growth potential ideas. For this reason, it is generally accepted that most venture capitalists will diversify their own holdings, as only 1 or 2 venture capital investments in 10 may give rise to a highly profitable exit opportunity, and most early-stage investments fail or run at a small profit. Companies that seek out venture capital will usually have little or no track record and may have never generated any revenue. This characteristic makes financing all the more risky and may explain why public IPOs, debt raisings, or bank loans are rarely an option for these entities at this early stage in their development. It is also usually in the company's best interests to remain private so that potential competitors are not privy to sensitive information such as new research and development that is more often than not the source of the company's value. Venture capital is prolific in the IT, technology, and even the biotech industries due to the risk and potential growth opportunities that these sectors present. Most venture capitalists also seek out opportunities in these industries to try to latch onto a new development that can be patented and then commercialized to generate significant future earnings. These investors usually have a relatively long investment horizon due to the liquidity issues involved with holding private equity. Once it is clear that the company is profitable, they may seek out exit opportunities in the form of a public IPO or perhaps even a private trade sale. This graph, sourced from Bloomberg, shows the performance of the US Venture Capital Index in black, along with other indices including the Dow Jones Industrial Average and the Nasdaq for the year ending March of 2009. This data set takes into account the devastating effects of the global financial crisis on these asset classes, yet seems to suggest that the US Venture Capital Index underperformed less than the Dow and the Nasdaq. It has been suggested that venture capital investments tend to underperform less in a market downturn due to their low correlation with other asset classes, and that in general they tend to outperform other asset classes over a longer time frame due to their longer investment horizon. This suggestion would be supported both by this table sourced from Thomson Reuters and the results that the case study has generated over the global financial crisis. A low correlation with other asset classes would mean that venture capital investments are an important risk-reducing factor in a well-diversified portfolio. It is, however, arguable that one reason venture capital tends to perform better in market downturns is the method that is used to value these companies. As no real market price is assigned to these private companies, they are often valued using a cost basis or by using the price used by the firm in its most recent financing. These methods of valuation are generally inaccurate in volatile conditions. This case study is based on a locally founded company that has performed extremely well since inception and is a fine example of a compelling venture capital investment. As the company is planning on listing and it is at this stage private, its name cannot be released in this presentation. This company commercialized revolutionary technology developed in a local university that was able to help client companies increase their presence in internet search engines to generate more sales. The company was initially funded by a government grant and then sought out private investors to expand their operations. Good. Since the company was founded in 2000, it has raised capital privately and expanded it into a global distributor. Its client list includes many companies who are leaders in their respective sectors, like Nissan, Nokia, and Toshiba. Perhaps the key to the company's success is the services it offers and the way that it chooses to charge its clients. Like Google, this company chooses to charge on a click model, charging clients a small fee for every hit their site generates as a result of the work. In this way, the company is essentially charging a commission on performance, which is a particularly attractive feature to client companies trying to cut advertising costs in a recession. The following financial results have been indexed to further protect the privacy of the company. These results have been tabulated since the company began paying out dividends in December of 2000. These results demonstrate very little correlation between the company's revenue or profit figures and the adverse effects of the global financial crisis. In fact, profit has risen explosively in the recent past. The type of services and the fee structure that it offers could explain the company's results. Private investors in this company have received an internal rate of return of 27%, and without taking into the effects of inflation, it is worth noting that in the 2 years since commencement of these dividends, these investors have almost recovered their initial capital. After analysing these results, I contacted the CFO of the company, and as a shareholder, he was happy to meet with me to discuss the performance of his company and his personal experiences with venture capital. So do you think that venture capital has played a significant role in developing the IT industry?
No question about it, because you have to have money and funding to do development work and to do marketing and creating those companies. So I think, is what made Silicon Valley what it is today, and why Adelaide is such a laggard, because there really isn't any venture capital funding worth mentioning here.
Okay, so in your own experience working here, was it difficult finding the funding to commercialise your ideas? And did you look at a number of different financing options?
It was very difficult to find funding in Australia. People don't invest in early stage companies, and they don't take risk. And it was also hard to find customers who would try and buy from a startup company here, because it's very risk adverse. So having said that, the one thing I think Adelaide and Australia has going for it is extremely talented people with very creative ideas. It just doesn't have the culture of risk-taking and to support innovation.
And can you explain why revenue continued to rise substantially throughout the global financial crisis?
Well, I think we had something that helped companies improve their performance that they needed. But having said that, we have taken a hit, and it was a delayed hit, I think, because of the global financial crisis.
Okay, so do you think that, what would you say the most significant impact of the global financial crisis has been on the company?
Well, it impacts, if the company is looking at listing and that sort of thing, you could no longer list, and there's, for the last 2 years, been very few IPOs of companies, and it's just starting to recover right now, and we'll see how that turns out. But valuations have gone down also, so as is most companies I've seen, their revenues have gone down also, and profits have gone down. So, but it's starting to change. I think it's turned.
Excellent. Well, thanks for your time and your input. It's much appreciated.
No worries.
In this instance, the company has taken a delayed hit to its revenue in its most recent quarter. That has mainly been attributed to a recently high Australian dollar that has affected the receipts of overseas sales. On the whole, the company has, however, continued to post record profits, affirming the view that venture capital investments have little correlation with other asset classes. This would suggest that there is a low correlation between venture capital returns and other sectors of the market, and would support the theory that in the long term, venture capital tends to outperform other asset classes. As a result, regardless of their risk profile, all investors should take advantage of the explosive value opportunities and risk-reducing benefits of holding a portion of their portfolio in high-growth potential private companies or venture capital funds.